VA IRRRL explained, the number one secret to saving money that every veteran with a VA loan should know. In the next few minutes, I'm going to show you one of the best financial secrets that the VA created for United States military veterans. We'll look at what it is, how the program works, how to maximize your savings with this VA program. We'll go over this simple rule to determine if it makes sense for you and how simple the VA made the transaction in general. We'll go over why people are not eligible for the program in a lot of cases. And we're going to review the differences between doing the program with a mortgage broker versus a bank. And we're also going to bust the top 10 myths associated with this program. We'll start by going over why veterans overpay higher interest rates on their mortgage than they need to, and how you can save a ton of money that you pay towards interest with this program. We're going to review
the number one way to increase your VA loan savings.
So what is the program? It's called a VA IRRRL, also called a VA Streamlined Refinance. But in the mortgage industry, we just say IRRRL, which stands for Interest Rate Reduction Refinance Loan, pronounced IRRRL. Yeah, like that guy. I don't know if it was a loan officer, a mortgage broker, or a veteran who first started calling it an IRRRL, but I can tell you this. When interest rates drop, IRRRL starts to become a veteran's best friend and your interest rate's worst enemy. And if you already have a VA loan, your buddy IRRRL might be able to save you a lot of money by reducing the amount of interest that you pay every month from here forward. But there's one key reason most people aren't eligible, and it's that you must already have a VA loan. This program is not for people that currently have conventional loans or FHA loans. It's available to veterans from all branches of the U.S. military, including the Reserves and National Guard. And it's designed to save veterans money by lowering their interest rates and reducing their monthly payments when market rates are lower than the rate that they currently have on their current VA loan. And on top of the monthly interest savings the VA requires on this program, there's one other thing that can save you a ton of money on a new mortgage. According to an article in Forbes magazine, homeowners can save an estimated $10,000 on their mortgage by doing this one simple thing, which I'm going to explain in just a moment. But first, there's a quote I love from probably the most brilliant mind of all time, who once said, "Compound interest is the most powerful force in the world." He also referred to compound interest as the eighth wonder of the world. And we'll look at how lowering your rate and payment through this program gives you the potential to not only save money monthly by lowering your payment, but it also frees up cash flow, allowing you the option to take the monthly savings and pay down high interest credit card debt. It even reduces the amount of interest that you pay annually, which lowers your monthly payment or allows you to pay off the home faster simply by making the same payment you're already making and not paying a penny more. And if you pay down your home faster, it can potentially save you a ton of money over the life of the loan. I've even seen the potential savings in the hundreds of thousands of dollars many times in my career, which dates back to 2004. My name is Jeff Brillian. I'm the owner and head broker of Paradise Home Mortgage, where we specialize in VA loans. I've been originating VA loans for over 20 years. I've trained and educated hundreds of loan officers, veterans, and realtors about the benefits of VA loans over the last 2 decades, and I was the number one loan officer for VA refinances in my state back in 2016, and was named the local Things to Know mortgage expert on the Channel 2 News back in 2018. I'm a little bit of a math nerd, and I just love teaching about this stuff. And there's no greater joy in my career than helping serve veterans that have served our country. I truly mean that. I come from a long line of Army veterans. Over the years, I've worked with veterans from all branches of the United States military, and even worked with surviving spouses of veterans that have passed on to the good Lord. Helping veterans navigate VA loans is something we take very seriously. And along with many veterans, I believe the VA IRRRL is the most powerful financial benefit available to veterans who already have a VA loan. The great thing about this program is that the VA puts 2 key safeguard restrictions in place in an effort to ensure veterans are only eligible if it makes sense financially. But there's one caveat to that rule, which I'll be sure to tell you about. So, number one, to safeguard veterans, the VA requires that the program must accomplish a net tangible benefit for the veteran. And number two, the veteran must recoup the cost associated with the transaction within a specific period of time, or the loan will not be approved to close. We'll dive a little deeper into both of those key safeguards in just a second. But the best thing about this program is that if you're eligible, once you do it, it'll reduce the interest on your mortgage every month and every year going forward on autopilot, as long as you always go with a fixed interest rate, which is what I always recommend. Which brings me to another quote from the person that's probably the greatest financial mind of our time, who once said, "If you don't find a way to make money while you sleep, you'll work until you die." It's a little dark, but you get the point. Any idea who said that one? Well, I'll review the answers in a few minutes when we hammer out and crunch the numbers on how those theories can apply to saving interest on your mortgage. But I like the premise of that quote because it applies to this transaction, in that anytime you complete a VA streamline, you do end up saving money by reducing the interest you pay going forward without having to do anything else other than simply make your payments, like with any mortgage. And because the rate has to be significantly lower to be eligible, you're definitely going to be saving interest on your payment every month. So how much does it have to save you? Well, on a $600,000 loan, it needs to save you an estimated $3,000 a year in interest, which is obviously a good amount of money. And over the life of a loan, that really adds up. So the amount the VA considers significant, and what they call the net tangible benefit, is the amount the rate has to drop by is 0.5% to be eligible. And I know that 0.5% might not sound like a lot, but if your rate is 5% and you drop it by 0.5%, that actually reduces the dollar amount of interest that you throw away every month by 10%. So it can be a ton of money, a ton of interest reduced when we're talking it off of hundreds of thousands of dollar balances. So some rough math here. And a quick disclaimer, I'm not quoting any interest rates. These numbers are for illustration purposes only. So for the easiest math, if you're paying a 10% interest rate on a $600,000 loan, what does that mean? Well, it means you're paying roughly $60,000 a year in interest. Because that's 10% of $600,000 is $60,000. So if you drop the rate 1%, you save roughly $6,000 a year in interest. So if you drop the rate 0.5%, you save roughly $3,000 a year. Now, these are just rough estimates because the loan amortizes, so there's a detailed equation we can do to get the precise amount. But this is the quickest and easiest way to understand and estimate the annual interest savings potential on a mortgage when your rate is going down. So if you currently have a 6%, you would have to drop it to 5.5% to be eligible. And it would save you roughly $2,000 on a $400,000 loan. But the rate has to drop by 0.5% or more. The great thing is, if you're eligible, it's not a one-time savings. You save money on interest every day that you're in the loan. But it's important you understand your break-even point, which we're going to go over. But first, have you ever looked at that box on your mortgage statement, your bill, the box that breaks down your monthly payment and shows you how much is going towards principal and how much is going towards interest each month? If you're like me, it probably makes you a little nauseous because sometimes double or sometimes even triple is likely going towards interest every month versus what's going towards principal. And it's the amount that you pay towards principal that actually pays down the balance. The part that goes towards interest just puts money into the bank or lender's pocket every month and does not help you in any way. So overpaying unnecessary interest is kind of like throwing money out the window while you're driving down the highway or burning money. Nobody wants to do it. Nobody loves a bank or a mortgage lender that much. I hope so, at least. So the great thing about this program is that it's designed to lower the amount that goes towards interest every month and actually every single day. Since you pay daily interest on a mortgage, you're saving every day. And it also allows you to pay more towards principal each month without having to pay a penny more than you're currently paying, which in turn is like saving money while you're sleeping. And saving money in your sleep is the next best thing to making money while you sleep. So, did you guess who made that quote? It was the financial genius and guru of our time, Warren Buffett. But it doesn't take a genius to understand that one of the number one ways that veteran homeowners build wealth over time is by reducing unnecessary interest and keeping more of their hard-earned money working for them. And this program makes it easy for veterans to accomplish just that. And the VA made it much easier than a typical conventional loan with this program. This brings us to our next session. Why do veterans overpay on their mortgage? Well, many veterans today are paying interest rates that were locked in between mid-2022 and 2026 when rates were higher than they've been in years, because the Fed kept raising rates to fight off high inflation after COVID. Raising rates is the Fed's main weapon in their arsenal to fighting inflation and bringing inflation down. So if you hear that inflation is back on the rise, that signals that rates will likely follow and rates will spike like they did after COVID. But when inflation is under control, rates move down, a lot of homeowners don't realize that they may have an opportunity to improve their financial situation. Paying a higher interest rate than necessary can cost thousands of dollars per year in extra interest. That's exactly why the VA created the interest rate reduction refinance loan.
In addition to the IRRRL saving money annually, monthly, and even daily in interest, what can be even more impressive is the potential lifetime interest savings in dropping your interest rate on a mortgage, and how much faster you can pay the loan off by simply making the same payment that you currently make. For example, on a $600,000 loan at a 6% rate for 30 years, your payment is $3,597 per month. Now let's say you've been paying on your loan for 2 years, and after you've made 24 payments, your remaining balance would be just under $585,000. And if you do an IRRRL and drop the rate to 5.5%, if you were to raise the loan amount to $595 to finance in the cost and the payment that you get to defer, your new payment would go down to $33.78. So the monthly savings would be $218.96 per month. But the astonishing part is the total interest savings if you were to keep making that same $3,597, but at that 5.5% rate. You would pay the loan off in 311 months, just under 26 years, instead of the 28 years or 336 payments that you had remaining at the 6%. So you pay off the home 2 years faster at the same payment that you're currently making without having to pay a penny more and without having to make any big lump sum payments. And the total interest savings goes up drastically because more money would go towards principal and less would go towards interest each month, because the total remaining payments you would pay at 6% would be $1,208,000, but at the 5.5%, you would only have 311 payments, and 311 times 3,597 equals $1,118,760, because you would pay off the loan in under 26 years at 5.5% versus the 28 years you had remaining at 6%. And that equates to an interest savings of $89,931. And you pay off your house 2 years and 1 month faster, eliminating over 2 years of mortgage payments.
Why the program is so powerful? Well, one of the reasons the VA IRRRL is so popular is because it was designed to be extremely simple compared to most refinance programs. Another name the VA even calls it is the VA Streamline, since everything about it is streamlined, making it much easier than a typical refinance. According to the VA, over 1 million veterans have taken advantage of using this program to lower their interest rates since the VA created the program. In most cases, there is no appraisal required and there's no termite inspection either. On other conventional refinance loans, you might pay upfront costs like application fees, lock-in fees, appraisal fees, just to start the process. But since these are not required on a VA IRRRL, you should not be charged anything upfront to begin. The VA actually specifically prohibits the charge of such fees before you start the process. So there should not be any upfront out-of-pocket costs just to start the transaction, unlike most other loan programs. There's also no income verification required, so no pay stubs, W-2s, or tax returns need to be sent in, because the VA knows if you're already proved that you can make the payment you're currently paying at the higher interest rate, then you should also be able to make the lower payment at the lower rate. There's also no need for asset documentation in most cases, so very little paperwork. Another benefit is that credit requirements are often more flexible. Lower credit scores are often not a problem, and in many cases, a hard credit pull is not even required, especially when using a mortgage broker. Because you already have a VA loan, the VA allows this process to be extremely streamlined. This is why many veterans say the VA IRRRL is one of the simplest refinance programs in America. Another advantage many veterans appreciate is the VA funding fee structure. If you're not a disabled vet, the funding fee on an IRRRL is only half a point, which is roughly 7 times lower than the funding fee is on a lot of purchase and cash out transactions. So it's a significant discount on this program. If you're a disabled vet or a Purple Heart recipient, you're exempt from the funding fee, so the cost is zero. And there's another major benefit. Even if your property value is dropped and you're technically underwater on your mortgage, the IRRRL can still work. That's because no appraisal is required. The only time it doesn't save you money on interest is if you're currently in one of those risky adjustable rates. You can do the IRRRL to get into a less risky fixed rate. In that case, which is kind of rare with this program, you wouldn't necessarily save money right away in interest monthly, but you can get out of that high risk adjustable rate and lock in a fixed rate, which can save you a ton of money in interest in the future and eliminate the risk of your rate and payment increasing. Adjustable rates are just a little too risky for me, unless the veteran has a specific reason they want an ARM, which I just don't see very often with this program. And I've overseen about 1,000 of these myself and with my team over the years. But like I said, if you have a fixed rate currently, we'll go to another fixed rate that's lower than the one you have. And you're going to save interest every month going forward. Either way, there's a substantial financial benefit to the veteran, and the VA's specific term for this safeguard is called the VA Net Tangible Benefit, or NTB. And it prohibits banks and lenders from approving the transaction if it does not pose a significant financial benefit to the veteran. The VA also puts another safeguard restriction in place, the VA's 36-month recoup requirement that ensures that a veteran's break-even point on the loan be in 3 years or it's ineligible. This ensures that there's an immediate benefit and so that the program is not overused and to prevent it from being completed for reasons other than saving the veteran money by lowering the interest rate they pay. Unfortunately, years ago, when the program was first introduced, there were people out there taking advantage of this program, and essentially the only benefit the veteran was getting was to defer a payment or two after the loan closed, and they weren't dropping the rate or payment significantly. So the VA stepped in and made it a requirement that the rate has to drop by 0.5% or more if the market allows, which, as we reviewed, would save you an estimated $4,000 a year in interest on an $800,000 loan. But even with these safeguards in place, there's still a specific circumstance where it still doesn't make sense. And this would be if you plan to sell the house within the next few years and you do not break even before the costs are recouped. That's why it's imperative that your loan officer walk you through your specific break-even analysis, like any mortgage broker would. The VA designed this program specifically to help veterans lower their interest rate quickly and easily, and they put safeguards in place to ensure it makes financial sense for the veteran and to prevent people from only doing it to defer a mortgage payment or two. And as with any transaction, it's very important to continue making your mortgage payments on time as normal while you're in the process of completing the VA IRRRL. The VA also made a waiting period to prevent veterans from doing the program more than 2 times a year. And that waiting period is 210 days from when your first payment was due on the loan that you're currently in. And you have to have made a total of 6 payments on the loan. Both of these must be true, so that if you buy a home and a month later you want to streamline to lower your rate, you can't just make 6 payments all at once or make them early, which is why you also have to wait 210 days from when the first payment was due. There are 3 requirements that the VA has they're extremely strict on, and there are no exceptions made on these 3 requirements. One is late payments. The VA won't allow the transaction if you've had multiple late payments in the last 12 months. While many banks may not allow any late payments in the last 12 months, we recommend consulting a broker because they're experts at finding low rates at lower all-inclusive costs than banks, but mortgage brokers are also great at finding lenders that will allow guidelines that meet your specific situation if you've had a late payment. Because one late payment should not cancel out your eligibility. And on a VA loan, 30 days is what we mean by late. This brings us to our next section, the differences between working with a mortgage broker versus a bank on your VA loan. And surprisingly, to a lot of veterans, there can be a big difference. So we're going to break down the pros and cons of each, which includes the number one way that you can save over $10,000 on your VA mortgage, according to 2 studies. And we'll go over the number one most important question you should always ask your loan officer when beginning any VA loan process. Many loan officers may only close 1 or 2 VA loans a year because over 90% of loans in America are not VA loans. That means most loan officers rarely work with VA loans. So whether you work with a bank, a lender, or a mortgage broker, it's very important that you have a loan officer that specializes in VA loans. For the same reason you want to go to your dentist for brain surgery. Nothing against dentists, but you want a specialist, which can save you time, money, and unnecessary headaches. So if the company you're working with doesn't have a VA loan division, then they likely don't have loan officers that are VA specialists. There are brokers and lenders that specialize in VA loans like we do at Paradise Home Mortgage. I know there's a lot of contradicting information out there about VA loans, and there are a ton of VA myths, but I know all of the information that I provided to be accurate from personal experience that I've had working on VA loans. And I want to assure you that all the information that I provide has been fully vetted and is based on a ton of real-world experience working on VA loans. And for example, I was the number 1 loan officer in my state for VA refinances back in 2016 and was in the top 75 nationally for VA loans overall in the country, which is out of about 500,000 licensed loan officers across the United States. So I've seen just about every scenario imaginable in real world settings. In addition, I was selected as the local Things to Know mortgage expert on the Channel 2 News, and I've shot TV news segments about the changes to VA loans and mortgages in general since 2018. And a lot of those segments you can even find on YouTube, on the Paradise Home Mortgage website, or by going to the Channel 2 News website, which is khon2.com/mortgage. And I hope you find all that information helpful, because I truly love educating people on this stuff. As I mentioned, my father was an Army veteran, but he was also a high school teacher for over 30 years. And his first job as an educator was teaching other veterans hand-to-hand combat during Vietnam. So the passion and drive to educate runs deep in my blood, which is why I've spent over 20 years training others on VA loan programs and guidelines. So I hope you can find the information that I provide to be valuable, because I know it may be different than what you've heard, especially if you're being quoted the bank's VA guidelines disguised as the actual VA guidelines. As I alluded to earlier, VA overlays are when banks or lenders add additional requirements beyond what the VA actually requires. This can include requiring appraisals that the VA does not require, additional documentation, higher credit scores, lower debt-to-income ratios, or greater net worth or reserve requirements. So even if you meet all VA guidelines, a bank can still decline your loan due to their internal overlays. I've been originating VA loans since 2004, and everything that I've shared comes from real-world experience, not just guidelines from a single lender. And just because one bank doesn't allow something on a VA loan doesn't mean that it can't easily be approved elsewhere. This is where mortgage brokers have a major advantage. Brokers can shop multiple lenders to find one without the overlay that could otherwise cause your loan to be declined. In contrast, if you go directly through a bank or lender and their overlays disqualify you, that loan officer typically has no alternative options. So avoiding VA overlays is one of the best kept secrets of working with a mortgage broker that banks and big lenders do not want you to know about. So the number one question you should always ask your loan officer when beginning any VA loan process is, does your company have any VA overlays? If they say yes, or if they don't know what they are, it is so important that you have them email you the list of their VA overlays before you provide any information to them. That way, you won't have any unnecessary surprises that could ultimately kill the deal. Which is why we feel this is by far the most important question to ask. In my experience, the requirements, timeline to close, and overall process that I've seen at mortgage brokers are more streamlined than I've witnessed at some of the biggest banks and lenders in our country. For example, if you don't work with a broker, some of the biggest banks and lenders may require things like an appraisal, even on the VA IRRRL program, even though the VA specifically does not require it, along with additional documentation and other restrictions. The key principle to understand is this: lenders can choose to follow VA guidelines exactly, or they can be more restrictive, but they can never be less restrictive than the VA. Otherwise, the VA would not guarantee the loan. When a lender adds additional restrictions beyond the VA guidelines, this is called the VA overlay. And at Paradise Home Mortgage, we would never recommend working with a lender that makes the process more difficult or more restrictive than what the VA actually requires for our veterans. I was even a manager 20 years ago at one of the biggest lenders in the country at that time and saw this being done at a high level. And a few years later, I witnessed it again at one of the largest banks in the United States. And in the end, I actually took a stand and had to quit my job and leave the bank because a veteran that I was working with was declined for a loan that met all of the VA guidelines that could have been approved if working with any competent broker. But at the bank that I used to work for, we were given a script to actually tell the veteran that they did not meet the VA guidelines. And that's why their loan was ultimately declined. But the truth was that the veteran didn't meet that specific bank's VA guidelines due to that bank's VA overlays, even though the veteran did meet all of the VA guidelines. So when I escalated this up the chain at the bank to advocate on behalf of the veteran and her family, I was told that even though she met all the VA guidelines that the VA requires, that she did not meet the additional restrictions that the bank puts on their VA loans. So she was declined from buying her home, and her family lost out on their dream home. But to make matters even worse, I was also told that I couldn't tell her that she actually met all the VA guidelines, and they prohibited me from advising her to pick up the phone and call a mortgage broker who likely could have gotten her easily approved so she wouldn't have missed out on the property. So this was an ethical dilemma that I could no longer be a part of, and it really was the number one reason that I chose to become a wholesale mortgage broker. I firmly believe that a loan officer's job is to act as a fiduciary, to advocate for their clients and do everything possible to help them out without ever doing anything unethical. And telling a veteran that they don't meet VA guidelines when they clearly met 100% of them is about as unethical as it gets, in my opinion. It's why I could not work another day at that bank. But typically, the most important thing that customers are ultimately looking for is the lowest rate at the lowest cost with the lowest monthly payment. And that's what wholesale brokers work to provide. But I actually started out in 2004 working at major banks and big lenders early in my career. But even still, the first 3 homes that I bought for myself before I ever became a broker, I actually went through a mortgage broker each time because the brokers had lower rates at lower all-inclusive costs than I can get myself, even with the employee pricing at the bank or big lender that I worked for at the time. So when combining the best deal with the best service, it was like getting the best of both worlds. Better pricing, faster closings, and less paperwork. But this isn't just me saying this. It's based on actual HMDA government data. According to an article in Forbes magazine, you can save over $10,000 on your mortgage by working with a mortgage broker. And more specifically, in another more recent Polygon research study, veterans actually saved over $13,000 on their mortgage when using a mortgage broker versus a bank or a direct lender. And since starting Paradise Home Mortgage, we've specialized in working with veterans, and we've helped hundreds of veterans and their families secure some of the lowest rates we could find them. And we're proud to be able to say that 99% of the clients that we've worked with have given us a 5-star rating. And from 2019 to 2021, Paradise Home Mortgage was recognized as the fastest growing mortgage company in our state, according to Pacific Business News magazine. And we were the #2 fastest growing private company in the state overall. We've been named the best of the best mortgage company by expertise.com. We're A+ rated with the Better Business Bureau. And we were even named a military trusted business by mybaseguide.com. We're licensed in 5 states: California, Colorado, Florida, Hawaii, and Texas. Feel free to shoot me a comment, send me a text message, or give me a call. We're always here to assist our veterans. I have people call me all the time for advice, and I even have other mortgage brokers and loan officers call me about VA guidelines. So if anybody needs any help when it comes to a VA mortgage, I'm always here to assist veterans in any way possible, even if it's not something that benefits me personally with a commission check. But because of all the inaccurate information that we've heard banks and lenders telling veterans over the years, because of all the bank and lender VA overlays, and due to the fact that VA guidelines are actually written in ways that are very difficult to understand, even for the underwriters that approve the loans, it brings us to our final section on VA IRRRLs. My favorite, the Mythbuster. I can never say it. The Mythbuster section. We're going to break down the top 10 myths on VA IRRRLs. At Paradise Home Mortgage, our mission is clear: to help veterans obtain low wholesale VA interest rates while delivering the best of the best award-winning service all of our veterans deserve. My team and I at Paradise Home Mortgage have originated thousands of VA loans, and about 90% of the loans that we've originated have been VA loans. So we know a little bit about them, and we want to show you how working with Paradise Home Mortgage can be the best decision you can make on your VA loan. Thank you for your service, and God bless America and our troops.